Welcome to this session of ZICA Academy tutorial on investment appraisal techniques. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, thank you for being part of this channel. What is investment appraisal? Investment appraisal is the process of assessing the viability or otherwise of the capital investment project. The process of assessing the viability or otherwise of a capital investment project is said to be the investment appraisal. So to appraise a capital investment project, it means you want to determine whether that project will be a profitable one. You want to determine whether the project will be a profitable one. You want to know if it's worth investing in or if it's worth investing in. You want to know if it is financially worthwhile. You want to know if it is viable. The process of assessing the viability or otherwise of a capital investment project is said to be the investment appraisal. There are two techniques of assessing the viability of investment projects: investment appraisal techniques. There are two techniques. We have the traditional techniques. Traditional technique. And the second technique is discounted cash flow techniques. Discounted cash flows techniques. You want to discount your cash flows. So these are the two techniques. Another word for this is non-traditional technique. This can also be called non-traditional techniques. So under this technique, we want to determine the accounting rate of returns, ARR, or return on capital employed. Then we also need the payback period. So under this technique, we want to calculate the accounting rates of returns and the payback period. Under this discounted cash flows techniques, we want to calculate the net present value and the internal rates of returns. So we are starting with the traditional techniques. Under this, we'll be looking at accounting rates of returns. Accounting rate of returns, ARR, or ROCE, return on capital employed. ROCE, accounting rate of returns. I've told you this can also be called return on capital employed. Returns mean profit. Profit over capital employed. Profit over investment. Your capital employed can be in form of investment you've made. So profit over investment. Therefore, accounting rate of returns is the ratio of accounting profit to investment. The ratio of accounting profit to investment. This can be calculated in two ways. So when measured on initial investment, it can be calculated on initial investment. So ARR calculated this way, the formula will be average profit before interest and tax over initial investment times 100. Or you can say average annual profit before interest and tax over initial investment. That will give us the accounting rates of returns. And the second method of calculating this, it could be calculated on average investment. It can be calculated on average investment. So the formula will become ARR equals to average profit before interest and tax over average investment. Over average investment times 100 over 1. So this second formula should be adopted if the examiner is silent. That is, if it is not specified on initial investment. That is, if you are not to calculate it on initial investment, always adopt the second definition. Average profit before interest and tax over average investment. Average investment will be initial investment plus scrap divided by 2. Average investment equals to initial investment plus scrap value divided by 2. That is average investment. Decision rule under ARR. Decision rule. That is, if you want to make the accounting rate of returns, if you want to use the accounting rate of returns in making decision. So the decision rule is to accept the project with ARR greater than or equal to the target rate or hurdle rate set by the management. Accept the project with ARR greater than or equal to the target rate set by the management. The rate set by the management. If the ARR is greater than that or exactly equal to that, so you accept the project. Suppose the target rate set by the management, if it is 20%, it means any project with ARR less than 20% is not to be accepted. So that is, before you can accept the project, then you take the one with ARR that is exactly equal to 20% or greater than 20%. So the advantages of ARR. Advantages of ARR. But for a mutually exclusive project, where you have more than one project, and the acceptance of one does not affect the acceptance of the other, you should accept the project with ARR, with the highest ARR. That is decision rule number 2. You accept the project with the highest. The one with the highest ARR is to be accepted, where the projects are mutually exclusive. So, advantages of ARR. Number 1 advantage of this method is its simplicity. It is simple to calculate and understand. Number 2 advantage, it's linked with other accounting methods. So, it's linked with other accounting methods. That means it relies on accounting data for its calculation. Then, it also makes use of all readily available accounting data. Those are some of the advantages of ARR. Then we have disadvantages of ARR. Disadvantages of ARR. Number 1, it ignores the time value of money. It does not take into consideration that $1 today does not worth the same amount in a year to come. So what $1 can buy today, that same 1 unit of dollar cannot buy it a year after. So it doesn't take into consideration that fact. That is, it ignores the time value of money. Number two, it relies on accounting data. No, we don't have a precise basis of measurement in accounting. So we have different bases of measurement: the cost, the net realizable, the replacement price, and many others. So since we did not have a precise basis of measurement, so using this, given the same accounting data, the two accountants that to carry out their calculation using different bases, they will not arrive at the same result. So that makes comparison difficult. So because of that, it serves as one of the limitations of this method, that is accounting rate of returns, that is ROS. So it relies on accounting data. So it fails to use cash flows. I want you to know that cash flows is superior to profit in decision making. That is why if you look at the example I'm about to provide, when you are given cash flow, you have to subtract depreciation in order to convert your cash flows to profit. So, and depreciation, the accounting depreciation is different from economic depreciation, and it is not a good measure of performance when it comes to decision making. These are some of the disadvantages of accounting rates of returns. Example 1. A project involves the immediate purchase of an item or plant costing $10,000. It will generate annual cash flows of $24,400 for 5 years, starting in year 1. The plant purchased will have a scrap value of $10,000 in 5 years when the project terminates. Determine the project ROS using A, initial capital cost, B, average capital investment. This question is obtained from Kaplan, ACCA Study Test, Financial Management. Solution. Remember, ARR is the ratio of average accounting profit to average investment. If you look at the question, you were told a project involves the immediate purchase of an item or plant costing $10,000. This $10,000 is the initial capital invested. That is the initial capital outlay. It will generate annual cash flows of $24,400. So you have for 5 years. So $24,400 will be generated for 5 years. So total cash flows, that is $24,400 times 5. So for 5 years, to be times 5. Remember, cash flow is not to be used for ARR computation, but the profit. So the total cash flows is $122,000. And what we need for ARR calculation is profit. So to calculate profit, you have to subtract depreciation. How much is the depreciation? The cost of the asset is $110,000. $110,000 less scrap value. The plant purchase will have a scrap value of $10,000. So if you subtract the scrap value of $10,000 from $110,000, then you'll be left with $100,000. So the total depreciation over the entire life of the project is $100,000. If you divide it by 5, that will give you the annual depreciation. That is 110,000 minus 10 divided by 5. That means you have annual depreciation of $20,000. But over the 5 years, you have the depreciation of $100,000. If you subtract $100,000 from $122,000, and then you'll be left with $22,000. This $22,000 is the total profit. The total profit over the project life is $22,000. So average profit is what we have in the definition. Average annual profit. Annual profit, that will be $22,000 divided by, remember the project life is 5 years. So divided by 5. So 22,000 divided by 5, that gives us $4,400. So the annual profit is $4,400. Now, from the requirement A, you have to determine the project rules using A, initial capital cost. So our rules, return on capital employed, we say it is average annual profit before interest and tax over initial investment times 100 over 1. Average annual profit as calculated is $4,400 over initial investment. Initial investment amounted to $110,000 times 100 over 1. Therefore, return on capital employed, 4,400 divided by 110,000 times 100, that gives us 4%. So that is the rules. That is the solution to A. In the B part of the question, you are to use the average investment. So you want to calculate the ARR using the average investment. Remember, I've told you that average investment is initial investment. Average investment, I've told you, is equal to the initial investment plus scrap divided by 2. And the initial investment amounted to 110,000 plus the scrap value. The scrap value is 10,000 as given in the question, divided by 2. So 110,000 plus 10,000, that will be 120,000. 120,000 divided by 2, that gives us 60,000. So the average investment will be 60,000. ARR calculated, or rules calculated on average investment. The formula is average annual profit before interest and tax over average investment times 100 over 1. Then, as calculated above, we have the average profit to be 4,400 over average investment as calculated, which is 60,000, times 100 over 1. So 4,400 divided by 60,000 times 100. Then we have 7.3%. Therefore, our ROS equal to 7.3%. That is the solution to example 1. Example 2. A project requires an initial investment of $800,000 and then earns net cash flows as follows. We have year 1, 2, 3, 4, 5, 6, and 7. Cash flows in $1,000, 100, 200, 400, 400, 300, 200, 150. In addition, at the end of the 7th year of the project, the asset initially purchased will be sold for $100,000. Determine the project's rules using A, initial capital costs, B, average capital investment. This question is obtained from Kaplan ACCA study test, financial management. Remember, the rules is average annual profit divided by initial capital cost. Now we need to calculate the profit. So we are given total cash flows, total cash inflows. You have the amount is in $1,000. 100 plus 200 plus 400 plus 400 plus 300 plus 200 plus 150. Total cash flows, we have 100, 200, 400, 400, 300, 200, and 150. The total is $1,000. That is 1,750,000. So from this, you less depreciation. And depreciation is cost, and the cost is 800,000 minus scrap value, and the scrap value is 100,000. If you subtract 100,000 from this, you have 700,000. So 700,000. If you subtract the depreciation from the cash flows, then you'll be left with 1,050,000. This 1,050,000 is the total profit over the entire life of the project. We have the total profit over the project life of 1,050,000. Therefore, average annual profit, that will be 1,050,000. The project life is 7 years. 1,050,000 divided by 7, that gives us 150,000. Therefore, the average annual profit is 150,000. Now that you have gotten the average annual profit, you want to calculate ARR, that is the ROCE, return on capital employed, and which is average annual profit, over initial investment times 100 over 1. So the average annual profit as calculated amounted to $150,000. And the initial investment is given to be $800,000 in the question times 100. So 150,000 divided by 800,000 times 100. Therefore, the ROCE, return on capital employed, is 18.75%. 18.75%. That is the solution to A. The B, you have to calculate the ROCE calculated on the average capital investment. Then we said average investment is equal to the initial investment, which is 800,000, plus the scrap, which is 100,000, divided by 2. So this gives us 800,000 plus 100,000, that is 900,000, divided by 2, that will be 450,000. The average investment is 450,000. What is the ROCE? ROCE is average annual profit as calculated above is 150,000 over average investment of 450,000 times 100 over 1. So we have 150,000 divided by 450,000 times 100. That gives us 33. 33.3%. That is the return on capital employed calculated on the average investment. I will stop this lecture here. In my next video, I will examine the payback period, the net present value, and the internal rate of returns. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.